The balance sheet is one of the four main financial statements, the other ones being the income statement, the statement of cash flows, and the statement of shareholders' equity. The one thing that differentiates it from those items are that the balance sheet is a point in time, whereas the other statements that you find are measured over a period of time, generally either a quarter or over a year. Now, the way we think about the balance sheet is it is simply this. We just think of assets minus liabilities is equal to the equity of the firm. So think about it this way. Is what you own, those are assets, versus what you owe, those are your liabilities, is equal to what you are worth. And that's the same for an individual person or a company. If you add up all your assets and you subtract out your liabilities, that's technically your net worth. And that's what we're measuring when we look at a company. The accounting equation up above is more commonly expressed this way. So we just move liabilities over to the right-hand side and we just say assets are equal to liabilities plus equity. So remember that. If you learn nothing else about accounting, you've got to know that equation right there. Assets equal liabilities plus equity. Okay, so let's take a look at what a balance sheet generally looks like. You usually have total assets on the top of the balance sheet, or at least on the left side. And you start with the most short-term assets first, the current assets, and then the long-term assets. Current assets are thought of as assets that you're going to monetize within the year. Long-term assets are something that helps you generate income beyond a year. Okay. Current liabilities, these are things that you owe over the next year. And then long-term liabilities are things you owe beyond a year. And then there's common stock, what you're worth, your net worth. Common stock, retained earnings, you add those together, and that's your total shareholders' equity. Now, let's do a hypothetical balance sheet here and put in some of the line items that would fill in some of these buckets. The balance sheet of XYZ Corporation, for example. So you've got current assets at the top, and let's say that you've got cash, short-term marketable securities. So these could be things like T-bills or even investments in corporate debt, commercial paper that's very short-term. So cash-like securities, accounts receivable. This is stuff that you booked as revenue, but you haven't received the cash yet. So you're still waiting for the cash to come in. Inventories, and then prepaid expenses. Prepaid expenses, you can almost think of those as like inventories. You've paid for something. So you've paid for something, but that company that's supposed to deliver that thing that you've paid for, they haven't sent it to you yet. So you can think about like Walmart. If you walk into a Walmart store, and maybe Walmart, they've got that gaming section in the back. Maybe they've purchased a bunch of Monopoly boards, and they haven't, and they went ahead and wired the money, but they haven't received the Monopoly games yet. And so it's kind of like inventory. It's just not in the house yet. So that's a prepaid expense. You add up all of that. Those are your total current assets. Your long-term assets, generally it's property, plant, and equipment. These are buildings. These are chairs for the offices. They're computer equipment. It's anything that you're not directly selling. It's helping you deliver your product. It's helping you put together the business and run the business. So property, plant, and equipment. And other long-term assets, there's always another category too. But property, plant, and equipment is going to be the main thing that drives long-term assets. Current liabilities, let's go to the liability side. Accounts payable, those are things that you have received, but you haven't paid for them yet. You haven't written the check yet. So you owe somebody some money. Accrued expenses, those are like wages that accrue and you haven't paid those yet in cash, but you owe them. And then there's, of course, there's always the other current liabilities line. So that's in there too. We add that up, current liabilities. Then you've got long-term liabilities, long-term debt. These are bonds or even bank loans that extend beyond a year. Other long-term liabilities, those are in there too. Those could be leases, things like that. Lease payments that you owe. So you've got all that. Total liabilities, 2592, and then shareholders' equity. Common stock, this is stock that you've issued to the public to finance your business. So, when you went public, you did an IPO, you issued stock, but maybe there were secondary offerings as well. Retained earnings, this is all the accumulation of all the earnings your firm has ever earned that you have not distributed out in the form of dividends. So retained earnings will go up by income and it will go down by dividends, all right, that you pay out. And then your total shareholders' equity is there. And then you'll notice your total liabilities plus shareholders equity. So if I take that 2973 number and I divide it and I add it to 2592, if I add those two together, I get 5565, and that's going to be the same number as my total assets. Assets must equal liabilities plus equity. Okay, so that the accounting equation holds here. All right, so let's keep going. Now, how might you get a test question on the balance sheet? Well, one common test question is that if they give you a lot of things, but they leave out a few things, and you have to infer what those numbers are or use deductive reasoning. The way I think about it is almost like playing the game Sudoku. You just start knocking out things that you can figure out right away, and then that helps you solve for other things. So let's take a look at this. You've got current assets, you've got total assets. Well, now that you've got total assets, you know that total liabilities and shareholders' equity have got to be the same number. Total assets must be, it is 5565, so total liabilities and shareholders' equity must be 5565. Okay, so we know that. So that's what I'm putting here. So let's go ahead and put 5565 there. Well, now that I have that, and I know what shareholders' equity is, well, then now I know what total liabilities must be. Okay, so given that shareholders' equity is 2973, total's liabilities must be 5565 minus 2973. So that's 2592. So that's got to be that number. And of course, this number here, total liabilities, is going to equal my long-term liabilities plus my current liabilities. So now that I know what my total liabilities are, and I know what my long-term liabilities are, I can add those two up. Then I can deduce what my current liabilities are. So my total liabilities are 2592. My current liabilities must be 2592 minus 1428 minus, it should say 590. And that would give me the number 574. Okay, and so I put that number there. Sorry, that was a misprint out there. That should say 590, 574. And if I take 574 and I subtract these two things, then that'll give me accounts payable, which is 460. And so that's how you might get some kind of a balance sheet question. They'll give you a bunch of things, and you're going to have to infer what something else is. And it's just using logic to do that. There's a lot of ways this question could be asked. We could do something on the asset side as well, for sure, or something within the shareholders' equity statement. All right, so let's keep working. A couple other things you might want to know. What's working capital and current ratio? These are questions that are often asked in basic finance courses. So working capital is simply your current assets minus your current liabilities. And so you just take this number here, current assets 1333, and you subtract out 574, and that gives you your working capital. And then your current ratio is simply the division between those. It's current assets divided by current liabilities. And that number here is 2.32. Generally, firms like to see that number at 1 or greater. If it's below 1, then you get a little bit worried because your current assets aren't big enough to pay off the current liabilities, and the current liabilities are things you owe within a year. So you're going to have to come up with that money somewhere else. Perhaps you can come up with it from income, for sure. That's possible, but it's nice to have a number that's 1 or greater. Anyways, that is the way the balance sheet looks, the way it works. And if you like this video, subscribe to the channel, and also give it a like, give it a thumbs up, because this is where I make finance fun for students. Thank you.